Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Roland Gib Stewart. Roland is an investor and a recently published author. He and his ex-wife started with $285 and have built that to $30 million in real estate and is still going. And in just a minute, we're going to speak with Roland Gib Stewart about how you can build wealth through real estate. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Roland Gib Stewart. Welcome to CRE PN Radio.
Thanks for having me, Darren.
Well, I'm looking forward to our conversation today. I've known you for a number of years, and I'm excited for the listeners to get a chance to know you as well. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Well, my background's pretty varied in reality, but I grew up in most of the major cities on the West Coast. My father was a medical supply salesman who was also an Army reservist, and I was born in Seattle. Most of my growing up was in Portland, Oregon. Then I went to Los Altos, California for a year, and then graduated in Santa Monica High School, then went to Willamette University, ran track. I also played a little basketball, but that was ruined by so I ended up in the infirmary. Then Army, United States Army, Officers Candidate School. My orders to Vietnam were canceled 24 hours before I got on the plane, which I was very thankful for. Got out of the Army, toured Europe for 3 months, and then tried to find a job, which was actually a very harrowing experience.
Got it. Well, so let's talk about how you got started in real estate, and what was the first thing you did, or how did you decide that real estate was a good thing to invest in?
Well, we had built up to $10,000, and we started to decide we needed to do something. And so we got an account with Merrill Lynch and had a very good stockbroker that grew that to probably 12 or 12.5. And then he went to manage I think it was one of the UCal Berkeley investment funds. Very nice promotion for him, but he hurt us. We got a new guy on the block, and he drove our account to exactly $0 and 0 cents. So the next time we built $10,000 was kind of by accident. I actually had a reasonable job by then, and Bonnie, my ex-wife, got a very good job. She was a tire, batteries, and salesperson for Chevron USA, and by the end of the year, we did a draft tax return about November. We said, "Oh my goodness, we're going to owe the government $10,000." So she turned to me and she said, "What can we do about that?" And I said, "Well, we can buy real estate." So we went out and looked at all sorts of things. We started with single family, and then we moved to duplexes and triplexes, and we finally ended up buying a 14-plex in Southeast Portland.
Wow. So did you actually buy single family properties prior to
No,
that, or did you just
no,
look at them?
no, we just looked at them.
Okay. Okay. And how long between the
We were
November?
trying to mitigate our risk, Darren.
Yeah,
Okay,
no, I appreciate that. I
so you
get
go
it.
to 14.
Yeah, well,
So you
well,
at least
pay,
got a few run.
yeah, with a $10,000 bill to the government, that'll make a lot of, I mean, that'll get your attention
Yeah,
and make you want to see what else you can do there. So
yeah.
I get it. So, but so from like November when you were doing this kind of pre-tax planning kind of thing to when you actually bought the 14 units, how how much time are we talking there?
I'm pretty sure we got it finished by the end of the year because I don't remember writing the check.
Oh, that's
Okay,
awesome. So
so
you were
so I
able to
think that was
accomplish.
it. But what happened was, of course, $10,000 even in those days wouldn't buy you a 14 unit complex. So I picked up the phone and I called a number of friends, and all five of them loaned me money. They loaned me from anywhere from $3,500 to $5,000. My college roommate sent that $7,500 to own a percentage of the building, and we bought the complex. Now the big hit came about 15 days later when they said, "You're going to be late with your first payment." I said, "Oh, that's going to hurt." I don't know where I'm going to find that money. I've mortgaged myself to the hilt. So I took the city bus over to their office, and I said to them, I said, I can't pay this. Now, what is there anything we can do? And they said, "Oh, we'll just put it on the end of the contract." So here
Hey,
another person loaned me $2,400. So I was really in debt.
oh, that's funny. The kind of the lessons you learn.
Oh
Uh,
yeah.
so your beginnings sound very similar to I know mine and I'm sure many others that I've talked with and others that are maybe listening. And that just absolutely just stretching as far as you can to get the deal done.
To do something. Right.
Yeah, to get into real estate. And so once you got in, how long did it take for there to be cash flow or to recognize that there was an upside and that you'd made a good decision and it wasn't going to continue to be stretched from limb to limb?
So we were probably full for 24 months. So things looked pretty reasonable. Then I had my first move out, and that was a rake out. I had to take a garden rake and rake it out because there was so much litter on the floor, and then I could vacuum it. So that was an experience, and I said, okay, if I can handle this, I guess I'm probably going to be able to handle this thing. And then our second move out was a move out in the middle of the night, and Bonnie was in a law class for her master's, and I ran back downtown and I said, okay, the prof said you can ask any question and he won't charge you if it's in class. Ask him what I can do about this. And he said, well, she came back out and he said you could help her move out. Well, that was a rude awakening. So, so at any rate, those are my first two move outs. And then the 80 recession, of course, hit us badly. And I spent a number of weekend days out on the street waving balloons or holding on to balloons and waving to people and trying to get them move in. I posted notices all over Southeast Portland, and we survived.
So you had the 14 plex. How long did you end up keeping that?
Oh, 22 years maybe,
Okay, so quite a while.
plus or minus. Well, we let it pay itself off.
Sure. And then did you acquire additional properties or how did you?
Oh, partway through that, maybe 8 years, maybe 12, somewhere in there. a friend of mine who was in real estate called and said, my business partner needs to sell, and all he wants to do is cover his costs to get out of a duplex. So we bought a duplex out in Oregon City. And so now we had two properties. And then a short while later, something came up. Oh, I know, I had to move to Pendleton. I became the state labor economist for Northeastern Oregon. And so we were I didn't want to own long-term out there. I bought a house for us. And so there wasn't much going on then. And then I went back to the director's office of human services, was a budget analyst in Salem. And then I was free again. And when things came up, people wanted to sell. I was a good target. If people wanted to sell, we kept accumulating money, which was kind of mostly the way we were brought up. Bonnie was brought up on a farm. They never knew when the crop was going to come in, so they were always living on a budget. And I was real malleable. She taught me how to save early on, and I still do.
No, that's a good habit to have, and also it's a good opportunity when somebody has to sell or wants to sell, as opposed to the people that really don't want to sell. I think a lot of times, what you see in the marketplace is somebody that wants a price, but they don't really want to sell, kind of thing. And if you're trying to underwrite a deal, it's important that you know what the numbers, or what numbers you can offer, and what makes sense, as opposed to somebody that doesn't, and not offer more than what you can offer,
Right.
kind of thing, to make it work. So you started off, you got the 14, you've added some additional properties. At what point did you venture into other asset classes? Because I've known you for a number of years now, and I know that multifamily is not something that I don't believe you're currently in. Are you still in any multifamily?
No multifamily. No, I think we may have one. I think we're down to one single family rental.
Okay.
Okay.
So what was it that what was the impetus, or the reason you exited that, and or for the most part got out of that, and got into more of the what I know you to do, a lot of the medical office, and also some office/retail kind of thing. What was it that
Luck, and luck, right?
luck and luck? Okay. All
Okay,
right.
so I was we were worth $1 million and when I was 48. So I decided I wanted to retire at 50. So I retired at 50, and then a dentist friend of mine said, you've been in real estate a long time. Can you help me find a place where I can expand my dental practice? So I did that for almost a year, and we never found anything. In those days, dentists' offices let out a lot of not very good smells, and so most landlords wouldn't rent to them. So after about a year of that, the dentist was driving home and saw a vacant lot next to a Fred Meyer, and Bonnie and I did a 1031 exchange and bought that. And then we went out interviewing developers. And after interviewing the third one, we were on the way back to his office to drop him off. And he turned to me and he says, I want you to develop this. And I said, who, me? I mean, like I have any idea what that would be like. And he went through and he said, you've negotiated contracts for 10 years. You've done this, you've done that. You can do this. So we decided we would go ahead and try that. And if I failed, we had the guy identified in those days. I think it was all guys. All three of them were guys. We identified the one we would go call and say, hey, can you bail us out of this trouble? And
Right.
it ended up being a home run. So it's like somebody told me once, if you hit a home run on your first one, you can hit button singles and doubles and triples for the rest of your life, and you'll be in great shape. So we were very fortunate.
So I didn't realize that you'd actually developed that one there by the Fred Meyers. Um, so developing, I mean, what was your experience there? I mean, that's a different, um, a different exercise than just buying and operating. Tell me a little bit about the development experience.
I was totally lucky. So we went out interviewing architects. We found David Welsh. Uh, we walked into his office. It was like the third or fourth office we walked into, and the guy had real modest furniture and And we said, this guy thinks the way we want him to think, right? And so we hired him, and he did a phenomenal job on that building. So that was the first thing I had to learn. And then the next one was, okay, now how do you get a contractor? So we had 3 or 4 contractors bid, and one of them happened to be the husband of a woman that I was on a church committee for. And she told him, she said, you better give a good price. So at any rate, he gave us what I thought was a really good price. So we hired him, and the building went up, and we already had the dentist ready to take 2/3 of the second floor, and we went from there.
That's great. So you've got a foothold on the medical office building asset class, and like I said, I know that you have several other properties. How quickly after that first one did you look to expand?
Oh, maybe 6 months. The
Oh,
con
really? So that
the contractor, not the contractor that did the building, the contractor that did the dentist's tenant improvements, called me. We went out to lunch. He said, we should build more of these. And that's what got me back in.
no,
Other
that's
than that,
great.
I would have been retired the second time, and I probably would have quit. Who knows?
Yeah, yeah. So tell me a little bit about the financing for these. I know that you and Bonnie were big savers, and you did a lot to make sure you had some ability to invest. But as far as these other properties, was the dentist, was he a partner in that first building,
Oh
or how
yeah,
did you?
yeah. He,
Okay,
he stuck until the end of when we stopped. Um, okay, so 5 guys. The contractor that talked to me into doing more, David Welsh, the architect, CETA, who's now totally retired because I called him on an investment last week, and he said, I'm old enough, I'm not investing in anything anymore. Now, whether that's true or not, he didn't want to give me $25,000. So anyway, okay, so our contractor, architect, dentist, my Army roommate, when I was after we graduated from officers candidate school, we went to Kentucky, both of us, and so we decided to room together. It was a CPA out of Florida, and me. So there were 5 of us. We all put in $2,500 in a pot, and we started.
that was it, huh?
That was it.
And so, as far as going forward, I know development is fairly well. I guess it all depends on how the bank sees the opportunity. How much did your experience and your success in the initial property give you credit, or did it weigh in your success with lenders and others?
Well, I found a number of banks to be open to the idea that if the architect drew the plans, he should get credit for that. Not that he would charge us for it, but he'd get credit for it. And the contractor could build the building, and the contractor wanted half of his fee in cash, but the other half, because he actually put the building together got credit for that. So that's that. I was the developer and I didn't want any money at all. So I got credit for that. And then each of the tenants that came in, most of them chose to do their own tenant improvements. So in those days, we were getting $10 or $12 a square foot per tenant. If you came off the street and you were a regular tenant, the market was saying you wanted $10 to $15 a square foot. So the bank would write in another line item that said this $15 per square foot was provided by the tenants. And then we had our down payment, we put the building.
No, that's great. So, and that's basically the way it was put together. Then the each one of the investors were participants at a level of effort, which was then recognized by the banks in the early goings. Is that
correct?
Oh, that's great. And did you, as far as the formal structure of the group, did you just 5 partners, each equal partners in an entity like an LLC, or was there different levels of participation?
A lot of research went into how much the architect should be worth, how much the contractor should be worth, how much a developer should be worth, etc. And we put those numbers into an LLC, and each of us got that amount of share.
Got it.
It was an LLC, and it changed over time. By the time it was over, there were only 2 of us left.
Gotcha. So, in from the first property to today, how many years are we talking about?
Give me a second. Well, I think I probably started the first one in 1998 or 9. So we're talking first 25 years, I guess.
Okay. And your strategy, have you sold any of the buildings, or have they all been long-term hold?
Long-term hold.
Okay.
And it's it varies by building who all's in, because not all the tenants came in, and we were really fortunate because we were out of money after the first building, because $12,500 doesn't go that far.
Yeah, I was gonna say this.
Okay, so so we met a group of accountants. They had their own LLC, and we were fortunate enough that they decided we had a good plan and they'd come with us. And they brought a chunk of money, and that allowed us to build the second building. Same premise, I didn't get paid, the architect doesn't get paid, the contractor got 50%. By then, Bonnie was doing the books because my Army partner came out and looked at the property, and he said, this is too big, somebody's going to get greedy and you're going to be in a loss. So that's the way that went. So we were down to 4. Bonnie should have probably been allowed to take over Daryl's share when he bailed out, but we never thought that far ahead.
Sure. So in the so that when the accountants came in, were they, again, they were partners or members of the LLC at the percentage based on their participation?
Well, their participation was based on their amount of money, and we gave them for building 2, 3, 4, and 5. We just spread the money out among those, and they became LLC members based on those.
Got it. But there was never, I guess what I was curious to understand, because so much of what I hear when I talk with others is syndication or JV, or it's rarely do I hear people talking about just kind of participating in a long-term investment at a level that represents what the worth you bring kind of thing, or the amount of cash you're bringing. Um, and as far as the LLC goes, is there anyone that's a general partner, or is it everybody just, it's all the members are based on the percentage
It's
that was
based on
determined based on the value?
percentage voting.
Okay. Okay.
And I've told people, anytime anyone wants to bail out, I'm more than happy to buy them out if the LLC doesn't. But every time it's happened, everybody else in the LLC has said, I'm in. And
Right.
so it's distributed among the members.
Right.
So it's easy, and it's really easy to form an LLC, as you probably
Yeah.
know.
Yeah.
And that's the only thing I was smart enough to do. I mean, when we formed the LLC for the first building, a guy who's become a friend and has been retired 5 years, he told me yesterday, drew up the papers for the LLC, and I said, well, here, this is my template. We go forward.
Yeah, no, it's nice to have a template as opposed to having to uh, constantly redo. And it seems to me a lot of the simplicity of your structure, it could be part of the secret. Whereas I think a lot of investors I speak with, the goal is to get in and then get out, and the attraction is more of the, if you can get in, you can increase the value, and then you can get out fast. Obviously your your return looks significantly greater as a quick hit, but then you have challenge. If you're able to do a 1031 exchange, or if you're just going to give most of that back to the government, kind of thing. And whereas you, with a long-term strategy, and the fact that or it sounds like the majority of your investors have stayed in the whole time, and had some sort of a long-term commitment to the plan. Was there? You mentioned that occasionally there have been people that have wanted out, and the LLC has bought their shares. Was there any, when you were putting this together and you were getting everybody together, was there any talk about what the long-term goal was, or was there ever anybody that was not in the same frame of mind?
Well, I think of the first 5 people, okay, architect, contractor, dentist, my Army roommate, and me. I think everybody thought that was going to be long-term. Pretty sure, not positive. I don't know that we ever discussed it. We just put $12,500 in a pot and started on our way. I bought 12.5% in a film company last week. Okay, and I think it's going to reach not full value. Okay, but I think I'm going to get maybe a 200, 300% return in like a 3-year time period. And I expect by 5 years, I'll be 500%. And then I think it'll probably keep on growing. I mean, the kid that's running it is 32 years old. He has 11 years experience in the film industry and has developed books. I mean, this thing's out of sight. So for me, it's a long term, right? Now, I'm going to be dead. Then my kids will have it.
Right. But the opportunity, I mean, you're not one that's always looking to get out. You're looking to get in and grow something for the ongoing,
Correct.
The revenue stream.
Correct.
And I think I think one of the things that I've always appreciated in our conversations over the years is that's my mindset has always been to get in, and it's the long haul. It's not always been about getting in and getting out, which I find so many investors, they want to get into real estate because they've heard about all the big wins that people have had, but don't always recognize the time that usually is associated with most real estate investors who stay. There's a big opportunity to win over time. And there's a lot of the value add where there was people who were either tired or didn't keep up with the market, and to bring that up to market, you can you can do that kind of thing. But really long term, that's always been my mindset. But let me ask you a question about debt with long term investment. Um, when I first started to invest, what I first saw was that if I had a tenant in my rental and they stayed long enough, whether it was them or them and others, that eventually that the note that I had against that property would be down to zero, and that would be I looked at it as like another 401k, you know,
Right.
uh, and that was the limit of my understanding of real estate. Uh, how do you see the use of debt with the portfolio you have, partners? Is it? I'm just curious. How do you view the use of debt for ongoing?
Well, I think I'm coming to that reality right now because I basically wiped out all my checking accounts to pay my tax bill this year. That's the first time I've been that low in a long time. So, so I have a feeling next year is going to be tough. So I probably will start accumulating debt. But again, ideally, I have 20 years left. I have such a good life. It's unbelievable, and I want to take every day out of it that I can. And if my health continues to be reasonable, and I get to still exercise as much as I like to in a day, and I can still make investments like I did last week, um, I'm excited every day I wake up. And it might mean that I have to start accumulating debt. If that's the price, I'm here, and as long as I can stretch it out and make the payments, I'm in good shape.
Sure. And as far as like your real estate, have you had goals to pay off the debt, or have you um, refinanced and done
Yeah.
cash
Almost every
distributions?
we've done cash distributions, but we haven't
Okay.
yet. And almost all of our real estate will have the second to last one paid off in 3 years, and the last one will be paid off in 6.
Wow.
And then
That's
everything we have in all the states is all free and clear.
that's impressive. And I appreciate you sharing that, because that's something that again, I think that especially in the low interest rate environment we just came from, there's a mindset of younger investors, newer investors, just get leveraged up to, leverage as much as you can, you know. Uh, and in the short term, I think if your plan is to get in and out, it makes, yeah, you can make sense of that. But for somebody that's really looking to hold something for, the duration, for or forever, uh, it clearly the strategy with debt is a different strategy,
Oh, very much.
and you may not get the interest write off, but you also don't have the debt payment. So uh, I appreciate you sharing that, because that's not something that I've had other guests comment on, because I think a lot of them don't have such a long term hold view of the situation.
And I just might not be smart enough to do the right thing. I mean,
Well,
I'm
but
comfortable with that. You know, I do the best I can. I'm as creative as I can be, and I take the risks that I find to be reasonable to me. Right. The other day, I met a young man who just seemed to be potential. Right. And I asked him where he was going, and he told me, and I said, "Well, why aren't you going there?" He said, "Because nobody has any money," which you and I know is false. I mean, that's just false. If somebody wants to do something, I can teach them how to get to $50,000 within a couple of days, right? So they
right.
got to want to do it. Almost anybody can do it. Um, so I said, "Okay, you got $100,000, my money. Let's go do something." So we went out and we reviewed 4 different companies, decided to buy one of them, and he's driven the company from 400,000 to $3.2 million over 4 years. So I mean, it was a lucky bet. I mean, he could have gone bankrupt, right? But and I could have been stuck with another $300,000 worth of debt because we bought the company for 400,000.
Wow. Well, but again, I think you are, I don't want to say you're unique, but I think you are rare in that I think most people, and I say most people listening to this podcast are entrepreneurial or looking to invest or looking for some way to increase their lot in life so that they have more assets, more time, more cash flow. They're financially free. I mean, that's really the goal of I think most everybody listening here. But by and large, in the masses, that's not the case. There's always the way to look to spend more than or everything you make and more, and not understanding that you need to do something beyond uh, your 8 hour or your 40 hours a week job where you're working for someone else. And so I appreciate you kind of sharing that.
Well, I explained to somebody the other day, I said, hold it. If you really want to do this and you have $500,000 worth of debt available on your credit card, get the 500 or the $55,000. Actually, it's 500. You take the 500 and you do it, and then you make it grow. And it's up to you to make it grow. And then you pay off that damn credit card because that's drowning you. Realize that's
Right.
at 16 or 18%, and you should be having that money for yourself. Pay it off. Decide.
Yeah. No, that's the availability of debt is endless. There's always somebody out there looking to lend you money, and recognizing the cost of that money, and but also like you just mentioned, the opportunity. If you have something you really want and you believe that you can go forward and improve your situation, whether it be real estate or a business opportunity, and that you can do this, I think that's more power to you. I mean, because that's a great. I mean, I know the more I've talked with people on this podcast, and the more I've gotten to understand the real estate, I've also come to understand the opportunity for people that own their own business. And real estate is a business. It's not just a rental property. I mean, when you're especially when you're buying commercial properties, um, and but there really is an opportunity to grow and improve your end result for your own personal finances. So I appreciate you sharing that.
I don't know if it's true or not, Darren, but to me, there is a shortage of really motivated people. I don't know if that's true, but I surely, I keep looking for people to invest in, right?
Yeah. No.
And my goal at the beginning of the year was, my New Year's resolution was to start associating with younger people. And so far, I've started to be successful in that. And I think that's important to get there and talk to them and learn from them.
Yeah. No. Definitely. That's what's coming as opposed to what's already been. Probably a good strategy if you're looking for the future
Yep,
and investing in the future.
I believe in
Again.
the future.
Yeah. Well, good, because we need to have something positive to look forward to. So that's good.
Yep.
Hey, Roland, if we could like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. And if that's not an option, we look to see if there's a way we can minimize the risk. And if we can't avoid nor minimize the risk, then we look to see if we could transfer the risk. And that's what an insurance policy is. And as such, I like to ask all my guests if they can look at their own situation. Could be clients, tenants, investors, political, um, however you would like to identify what you consider to be the biggest risk. And for clarification, again, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Roland Gib Stewart, what is the biggest risk?
Well, I think right now the biggest risk is the availability of money. Okay, so we got a lot of money available today, right? So in July, when the country hits its debt limit, what's going to happen? Are we going to all collapse? Is this whole thing going to just, the glass is going to break, and we're going to all be wondering, can I really get the money out of my credit card? I want to eat this week. I'm having fun. How do I continue this? So my biggest concern right now is that somebody's going to push us over the edge, which I think will damage the entire world's economy, and our country will never recover. And I don't want that for my kids or my grandkids.
Yeah, no, that's a kind of a depressing thought to think about, but there's a lot of pressure, and I think the thing that always gets me um, kind of frustrated is that how many people uh, have the ability to push it beyond for their own benefit, while and not necessarily concerned about the consequences, kind of thing. Which um, that's kind of a personal perception sometimes, but I get it. Roland, we didn't yet mention you. I mean, I mentioned that you're an author, but tell us a little bit about the book you've written.
I brought it over. Learn, apply, and grow rich.
All
Okay.
right, that's
I,
that's a good 1, 2, 3 there. I like that.
I've never considered myself really smart, but when I first got into real estate, I had one heck of a lot to learn. Shortly after, I got to be pretty friendly with the chief lieutenant for the contractor that sold us the building, and a few months down the road, he says, "You just need to know that your two worst nightmares, as long as you stay in this business, are going to be keys, and the second one is parking." And to this day, two of my things that haunt me are keys and parking. Luckily, I pushed that off on someone else, but let me tell you, those are the two things you got to worry about.
No, that's funny. The keys and parking definitely something to be concerned about.
Right.
Roland, where can the listeners go if they'd like to learn more or connect with you?
My email address is continueforward@live.com. And it's just all spelled out. Continueforward@live.com.
Got it. Well, Roland Gib Stewart, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I always enjoy it when I talk with you. Learned a lot, and look forward to doing it again soon.
Thank you, Darren. Appreciate it. Take care.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Till next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.